Hello and welcome to this week's show. Thanks so much for joining us today. I'm your host Trey Winowitz and you're watching Right on the Money. Our goal for the show is to always equip you, the viewer, with accurate financial information so you can make educated decisions for both you and your family. Now we've got a great show lined up for you today, so thanks for watching. We're going to be tackling some difficult financial questions, and we want to take some things that could be somewhat complicated and make them simple and easy to understand. So come on in and have some fun with us today.
In the aftermath of Hurricane Katrina, Trey Winowitz was forced to move himself and his family over 600 miles north and begin his financial planning practice again, from scratch. Since then, Winowitz Financial has become a national success story, establishing itself as a trusted source for financial advice in and around East Tennessee. In return, Trey gives back to the community by sponsoring monthly educational workshops and annual charity events. He also hosts a weekly radio show informing and entertaining those in need of financial advice. So, if you'd like to understand more about today's challenging financial environment, if you'd like to overcome your current financial situation, and want to learn from someone with a track record of overcoming, stay tuned for some trusted financial advice that's right on the money.
Now let's get to our main topic, annuities. Whenever I teach financial seminars, I get many questions about the different varieties of annuities out there. But before I can tell you about all of them, let's start with a definition. According to Investopedia, an annuity is a financial product sold by an insurance company designed to grow funds and then pay them out in a stream of income to the individual at a later point in time. Annuities are primarily used as a means of securing a steady cash flow for someone during their retirement years. Now, I've noticed over the years that people's opinions of them varies depending on what they grew up with or what they learned regarding investing. Just like I would tell you if you came into the office or attended one of our seminars, keep an open mind and we'll discuss the facts today. So you can become more educated about the annuities that you have or whether an annuity could even help you in your overall financial situation. So here's what we're going to cover on today's show. The history of annuities, number one. Then we're going to discuss two types of annuities, the pros and cons of each types, and finally 5 annuity mistakes that investors make. By the way, I've got a unique giveaway for today's show. It's a comprehensive 20-page white paper on the history of annuities. We'll be quoting from it a little bit today, and we're talking about some of the information included in this free report. I'd encourage you to call us, email us, or send us a Facebook message to get your free copy of this white paper. Now let's talk about the history of annuities for just a moment. In ancient Rome, speculators sold financial instruments commonly known as annua. This translated the jargon at the times as annual stipend, which means annual payout. Now that still applies to annuities today. Like so many other incredible innovations coming out of ancient Rome, the aqueducts or the Roman arches, the annuity remains a fundamental building block for financial security. That's really nice.
Thank you.
Is that the best you can do?
Et tu protect?
Is that Jessica's dress? You think about it, how many financial instruments can actually claim the awesome, time-tested power of the annuity? Available to investors for more than 2,000 years, the annuity has proven itself to be one of the oldest and most enduring, historically dependable financial tools on earth. Coming up after the break, we're going to go through the different types of annuities and the pros and cons of each. You won't want to miss the next segment. I'll see you right after the break.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
Thanks for joining us, and you're watching Right on the Money. I'm your host, Trey Winowitz, and today we're talking about the history of annuities. In this segment, we'll go through the different types of annuities and some pros and cons of each. There are many different types of annuities you could look into, and they do a variety of things depending on your investment needs and goals. I want to help you gain basic understanding of all the various types so that by the end of the show you feel like you understand them all a little bit better. The first type of an annuity is the immediate annuity. This annuity, the investor gives the insurance company a sum of money and in turn receives a guaranteed payout for a certain amount of time. Depending on the investor's age, the payout could be higher or lower due to their life expectancy. Generally speaking, the older the investor is, the higher the payout is for an immediate annuity. The pro, or a positive of this, is the immediate annuities are income streams that are guaranteed. However, the con is an immediate annuity, the investor loses a bit of control over the assets from the insurance company. The next few types of annuities are used for growth on principal as well, whereas only immediate annuities are used for just income. At the other end of the spectrum is the variable annuity. Now, before we go any further, let me ask you a question. What do you think the principal of a variable annuity does?
Goes up and down.
That's right, because variable annuities are made up of sub-accounts like mutual funds. Like normal mutual funds, the principal of these annuities go up and down because they're invested directly into the stock market. Despite what you might have been told about these products, they are securities. That means you can lose interest and principal. I'll have to say this is the most misunderstood investment that gets brought into the office on a weekly basis. I've been doing this for 12 years and have yet to find one person who completely understood how their variable annuity worked. A word of caution, when your broker starts talking about guarantees along with showing you a variable annuity, don't make a decision. Get his recommendations in writing first, then give me a call for an independent review. Variable annuities also have some other riders and features that you can pay for, like death benefits or income benefits. But if anyone tells you that a variable annuity is safe, well, I just want to make sure that you get the whole story. Not to get off topic, but I had a couple come in the other day to review their annuity the bank had sold them. The husband had worked with the bank for over 15 years on all other types of investments, and he trusted them very well. To make a long story short, he was paying over $32,000 a year in undisclosed fees. So I would tell you, if you have an annuity and you didn't buy it from us, bring it in when you come in for your review. We're going to take a short break, and when we come back, I'll finish up discussing the different types of annuities. Stick around for more advice that's right on the money.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
And we're back. You're watching Right on the Money, and I'm your host, Trey Winowitz. Today we've been talking about annuities. We've covered 2 of the 4 main types, and now we're going to cover the 2 types of annuities with complete principal protection, as opposed to variable annuities where your principal fluctuates up and down with the stock market. These next 2 annuities can never lose value due to market fluctuation. The 2 types of these annuities are fixed annuities. They are fixed and declared rate annuities or fixed indexed or market linked. The declared rate annuity is commonly referred to as a CD annuity. The reason is it works a lot like a bank CD. You choose a term, the company guarantees the rate for that term. Now, unlike immediate annuities, these annuities are used for growth and you're not forced to take income after the term. Now, when you're dealing with fixed annuities, you're also backed by the ability of the insurance company that you're working with to pay the claims. When you research the reserve ratio required by the insurance company, you'll discover and understand why I've never been able to find an instance where someone's lost money in their fixed annuity due to the company having financial problems. In addition to this, the security by the companies, each state also has a guaranteed fund to ensure investors are made whole if there is a problem with the company, similar to the FDIC for CDs. Now, the second type of fixed annuities is the fixed index. This type is the one I personally own because interest rates are very, very low and the stock market is very volatile right now. It's also one that many clients of ours own, and they use it specifically to protect their principal. A fixed index annuity means that instead of a declared rate each year, the yearly rate's calculated on the increases of a particular index like the S&P 500. The difference between this and a variable is that a fixed index, your principal is not invested in the market. The company each year gives you a maximum gain, capping out your gains around 15% or so. But more importantly, they put a floor of 0 on the contract in case the market index has a down year. The end result of this strategy is you can keep your principal and interest safe and earn about a 3 to 6% return, while your account will go up, but it'll never go down. Please be aware of the terms of any contract. Now, the cons of these is I see some people who have purchased annuities from other companies, and in my opinion, the term is way too long. The longer the term, the higher the surrender charges if you needed the money early. Also, I'd make sure that your annuity has little or no fees at all. You'd be surprised how many people come into the office for a review of their current plan so they can make sure that it's what they need and that they're not overpaying any outrageous fees that they didn't know about. I can help make sure that this doesn't happen to you. Just give us a call at the office and schedule a review of your current annuity contract. Our bottom line for today's show includes the top annuity mistakes I see at my office on a weekly basis. Number 1, buying a contract that's too long. Please don't do this. There's plenty of great short-term accounts out there. Number 2, you got to understand the fees and the cost of your contract. Give me a call. We can do a fee analysis so you'll know the truth about your contract. Number 3, please don't buy a product with a market value adjustment. I don't have time to cover it all on today's show. I would just tell you that if you're an investor, you don't want an annuity with an MVA in today's market. Give us a call. I've got a list of over 10 companies that have MVAs on their products. Also, not working with an independent advisor. The only products, if you do that, are going to be the ones that the broker has in his inventory. You may not get the very best ones for you. Finally, not working with a professional. Just because your neighbor or relative thinks that the contract work a certain way, it doesn't mean they really do. More times than not, there are some very important details left out of the contract whenever it's purchased. Let me help make sure that doesn't happen to you. Now, we've got to take another short break, so I'll see you in just a second.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Now that we're back, I'd like to tell you about some real-life folks that you may can relate to, because it never hurts to have an extra pair of objective eyes take a look at your situation and see what can be improved. Even if strategies that you're using can't be improved on, sometimes people say it's a huge comfort when I tell them that what they're doing is working well, or maybe they should continue on the same path. However, in some cases, we discover that some of the products or strategies they thought worked in a certain way actually don't. And sometimes not getting a second opinion can be very costly. If you want to be a part of this Money Matters segment, please give us a call at the office for a complimentary review. As you'll see, everything's kept confidential, but your situation may help some of our other viewers secure their financial future. So give me a call and maybe your case will get picked for the show. I want to take a second to introduce you to a few people who came in the office recently for a no-obligation second opinion, just to be sure. And these people were glad that they did. So let's take a look at this week's case. Hey, Jana, can you bring me my notes? Thanks. All right. This week's case study comes from Knoxville, Tennessee. We actually had an 80-year-old retired engineer. His wife was 81, and she actually was a retired school teacher. They came in after watching our television show and then signing up for one of our monthly educational workshops. Main concerns for this case: they had a lot of CDs, and over the years they had had some really reasonable rates on them. Of recent, the CDs were renewing. They were really, really low, looking for better alternatives for their interest, but also wanting to keep their money liquid. They weren't sure what to do with their RMDs. This is the required distributions from their IRAs that they were forced to take. Lastly, they had some concern about preserving their assets. They wanted to pass it on to their heirs very efficiently and weren't really using a lot of the assets that they had accumulated, so they wanted a distribution and a preservation plan. Steps to success. We took some time, analyzed their current situation, talked a lot about what their goals and their needs were for the money and what it was for in the future. We also took them through our annuity fee sheet. They had a couple of annuities that they had purchased years ago and did not realize the amount of money that they were paying in fees. We researched other alternatives that had no fees and were a little bit safer, and then we also shopped some guaranteed rates and some other liquid alternatives to improve those returns on the CDs. The results were these. We were able to find them some really good short-term guaranteed rates that paid some good rates, some good dividends, and kept their money liquid, which is what they wanted. Also, we discovered on some of their annuities, they were paying over 3% a year in fees and had no idea. So we were able to find some better alternatives that we could eliminate that fee that they were paying every single year. They didn't have to put their money at risk to make a return, and their money was way more efficient. Also, we were able to reposition some of their managed money accounts. They had some money still in the stock market, which they were good with, but we actually repositioned it to some of our managers who had a proven track record of helping avoid downturns in the market. This was very, very good and helped accomplish their goals of leaving more money to their heirs when they passed. Give us a call today for a complimentary review, and if your scenario gets picked for the show, you're going to receive a Right on the Money prize pack. But most of all, we want to help you. Coming up next, another opportunity for you to be a part of the show. Post it on our Facebook, tweet us, or email us your financial questions, and stick around for the viewer mail section.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Welcome back to Right on the Money. I'm your host, Trey Winowitz, and it's time for you, the viewer, to be an integral part of this show, Viewer Mail. This is the part of the show where you send us your questions about anything financial. In order to get your questions to me, you can post them on our Facebook page, tweet your question to me at TreyWTV, or email them to me at advice@TreyWTV. If your question happens to get answered for the show, you'll receive a Right on the Money prize pack just for your willingness to help out our other viewers. This package has a retail value of over $50, so please don't stop sending us those questions. Our first viewer mail question today is, what is a market index? Once you decide which index is appropriate for you, if any are, you can invest directly into a particular index. But a lot of people come into our office What they realize is you can put money into accounts that follow a given index. For a more conservative investor, this may be a great choice. You give up some of the potential gains of that index, but you get the protection and safety of your principal and any interest you earn. These products can be purchased from an insurance company or on a bank platform. They come in CDs that are FDIC insured, and as well, they have a minimum guaranteed interest rate. But when considering any investment, please sit down with a qualified professional. Also, make sure they're licensed to give you financial advice in all areas. Otherwise, the advice that you get might be a little bit one-sided. Thanks for the question. And our next question is, what are asset classes? You know, there are also other types of investments like real estate, precious metals, and annuities that you may want to consider. But be careful when you talk to advisors that recommend a whole bunch of different types of mutual funds without really offering you anything else. This is very, very traditional advice, and it simply spreads out your risk. In today's market environment, you want some of your risk eliminated. In order to do that, we might need to look at some things that they're not showing you. Thanks for the email. Keep them coming. The last question we have time for today is this. How much life insurance do I need, and what type should I buy? You know, this is a great question, and it differs from person to person and depends on a lot of different factors. Usually, people carry more insurance when they're young and have more debt to replace their income. Most advisors recommend 6 to 10 times of your income, but you may not quite need that much. If you're shopping around, make sure that you use an independent agent. They'll be able to shop multiple companies based on your individual situation and help find the best fit for you. Give me a call at the office and we can sit down and go through this question specifically to you. Also, if you have any other financial concerns or questions, before you come in, please make sure you watch our life insurance show. I'd be happy to send you a free copy of that DVD just for sending in your question. Thanks a lot, and keep them coming. Stick around after this short break for Right on the Street. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
And we're back. This is Right on the Money, and I'm Trey Winowitz. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know. What's a bull market in relation to the stock market? What does that mean?
Bull market, just say, I don't really know.
Okay. Concerning the stock market, what is a bull market?
When stocks are doing really well.
That's exactly right. When the stocks are doing very well, so conversely, a bear market would be when?
When they're not doing so well.
Right.
Bull market's when people are selling.
Okay.
Bull market is something that you...
Can you make money in a bear market?
Yeah, if you qualify.
Okay, if you qualify.
Yes.
Good. That make a bear market.
When people are buying.
Okay. If you're using a buy and hold strategy in the stock market, when would be a good time to sell?
Let's see. Maybe in the summer.
Okay.
Well, that's a hard question.
Bonds. Are bonds safe?
Yes,
Okay. Can you lose money in a bond?
sure. You can lose money in anything.
What is a bond? Do you know what a bond is?
When you love somebody and unrepeatedly maybe.
I like that. My wife and I feel the same way.
Yes.
Do you think you can lose money in a bond?
Yeah.
I agree. Well, how much risk should someone take with their money?
I think it depends on your age.
Okay.
I think the younger you are, you're okay with taking more risk in the stock market because you have a better chance to make your money back.
And how much risk should someone take with their money?
Well, I think that depends on the person. Some people are a little more willing to gamble than others.
Well, when they get to the age of old age,
Old age, okay.
I think you're asking me a lot of questions. Maybe I shouldn't be answering these questions.
No, these are all great. And can I borrow $20?
I don't have $20.
Okay, thanks. And last question, can I borrow $20?
No.
Okay, man.
Thank you.
Thanks for joining us, man. And can I borrow $20?
Sure.
All right, thank you very much. That's awesome. One last question. You look like a very well-dressed and wealthy guy. Can I borrow $20?
$20.
Uh-huh. You got 20 bucks I could borrow? Come on, man. You got 20 bucks?
I don't have it then.
Okay, no problem, man. Hey, thanks for your time.
And we're back. This is Right on the Money, and I'm Trey Winowitz. We're just getting ready to wrap up the show, but before we go, I'd like to tell you about an old Louisiana tradition called lagniappe. Lagniappe means to give someone a little something extra, and the way that we want to do that here at Right on the Money is to brighten your day at the end of our show. So with that, here's a little lagniappe for you. So 3 leading economists took a small plane into the wilderness to hunt moose over the weekend. The last thing the pilot said was, "Now remember, this is a really small plane and you can only bring 1 moose back." But of course, they all killed one, and come Sunday, they talked the pilot into letting them bring all 3 dead moose on board. So just after takeoff, the plane stalled and crashed. In the wreckage, one of the economists woke up and looked around. He said, "Where are we?" Another one quickly answered, "Oh, we're about 100 yards east of the place we were last year." The moral of the story is this: consistent bad economic advice gets you to the exact same place. And that, my friends, is a little lagniappe for today. I want to personally thank you for watching our show today. I hope you found our show helpful as well as a little bit entertaining. If there's anything at all I can help you with financially, please don't hesitate to call our office. And remember, any plan that we come up with will always have 3 main goals for your money. Safety first, or protection of your principal, is always number 1. Making a reasonable return on your money in what some would consider an unreasonable market. And number 3, keeping your plan simple and easy to understand. If that sounds like something you want, I know I can help you. Also, please keep the financial questions coming. We'll do our best to get them answered on the show. I'll see you next week at 3 o'clock for more trusted advice that's right on the money.